Hi, I'm Manish Dhawan with my good friend Puneet Khurana. We run a blog by the name of stoicinvesting.com. This is our podcast series. Life is too short to learn from just your own experiences. To inculcate vicarious learning, we will be interviewing and profiling interesting people from different walks of life. Hopefully, this endeavor will shorten the learning curve for our audience.
Well, hello listeners. Welcome back to the Stoic podcast series. Now, if you're starting out your market journey or you are an established market participant, if there is one book series that you would have enjoyed or you will enjoy, it's the Market Wizard series. The book has inspired and guided millions of traders, and what differentiates these books from other profiling attempts of traders and interviewers is the amount of depth that the interviewer goes into. Today, we have with us the interviewer extraordinaire, Jack Schwager. Well, I am a fan of his books, and so is Manish, my co-host for this podcast. Well, to ask great questions, you need a good in-depth knowledge about the subject, and that ability to put the guest's answer into a practical context at the time of the interview only, and then ask questions which will make it beneficial for the listeners is what we strive for. That's always been our attempt, to give something practical and implementable to our listeners. During this podcast, I'm so glad that I have Manish with me. Well, I, being a fundamental value-focused investor, could not have done justice to this podcast. Jack's most work is in the field of trading. Manish, on the other hand, had his arsenal full with some very amazing questions. And I thoroughly enjoyed taking a backseat and listen to both of them talking, rather than interrupting them with what would have been some very naive questions from their vantage points. Well, I hope you enjoyed this interview as much as I did. With that, Stoic Podcast Series brings you Jack Schwager. Well, Jack, welcome to Stoic Podcast. It's a pleasure having you here. And
Thank you.
I can't tell you what an honor it is to host you on our show. And I'm pretty sure that the listeners are going to take away a lot of learning from today's podcast. So I will request Manish first to ask a question because he's a big fan and he's a trader. I am a value investor. So I will have pretty less questions, but Manish will shoot the first question for you.
Okay, sure.
Right, Jack. So today, we are profiling the profiler. So first of all, let me tell you, Jack, that what an honor it is. Like Puneet mentioned, I've grown up reading your books and love the way you've brought up those characters to life. In fact, I came to know about Ed Thorp through your book, and since then a lifelong following has ensued.
Thank you very much.
Right. I learned a lot from Thorp's FAQ website about risk management, but also about how to conduct oneself in right livelihood. So thank you very much and welcome to the show.
Thank you.
Right. Jack, so if I have done my homework right, you started your career as a fundamental analyst, right? And
That is correct.
And later, due to some influence of Steve Kronovich, realized that technical analysis is not all voodoo and maybe there is something to it. So can you talk us through this transition? First, why did you discard fundamentals? And B, was it hard to do since you must have spent good 5 years of your career doing fundamental analysis, right?
Yeah. So, more than that, as far as the job goes, I started out career. My job was not trading. Trading was just something I did on the side. But my job was I was hired as a fundamental analyst, and I did that for a couple of years, and then I thought I could do better, so I looked elsewhere, and I wasn't getting financially rewarded in my own firm, I didn't think. So I just stuck my head out and saw what was available, and was able to get a research director job, which in those days was primarily, insofar as that job, I don't know if the job even exists, director of futures research, but in those days, as far as it did exist at every major brokerage firm. And the job was mainly a fundamental job, fundamental analysis. May have been a little bit of technical analysis, but it was more of a minor thing. So basically, my primary focus was fundamental analysis, both for myself and for analysts who worked for me for quite a number of years. And I started trading, obviously, using the same type of approach because that's the analysis I was doing. And the fact that I felt comfortable or thought that was a proper approach is easily explained because my education was as an economist. So as an economist, I would naturally gravitate towards more fundamental type of approach than technical, which did seem, as you said, like voodoo without really knowing anything about it. So that's why I started that way. Now, I had a problem with one problem I had is I wasn't profitable. Of course, that was the major problem, but it didn't work. It didn't work in practice. I mean, it worked, and then the trouble is it would only take you to be wrong once, and it would do a lot of damage. And there's an inherent problem, and I don't mean this as a knock on fundamental analysis. There are many traders I interviewed who use fundamental analysis in one way or another, and some used it exclusively and were very successful. So I think for some people it could be the right approach. But for me, the problem I ran into was, well, many problems, but there's maybe the biggest inherent problem is that by its very nature, fundamental analysis is almost naturally in contrast with risk management. By that I mean, let's say you do your analysis and I decide copper is a good value at $3, a pound. Well, if it goes to $2.50, then it's a better value. If nothing is structurally changed,
right?
And so the more it goes against you, the stronger the fundamental case becomes for your position.
Right.
And of course, it's very, very difficult to construct a risk management approach if that's the case. So that was the inherent difficulty. Whereas in technical analysis, basically, it's almost inherent in the approach that there's some sort of risk management. For example, if you're a trend follower, take the simple example, well, you're with the trade until the trend changes. So when the market starts going against you, you get out, and therefore you'll be getting out when you're losing money. In fundamental analysis, you'll be tempted to add when you're losing money. And that's what makes it so difficult. And for me, that one element was an insurmountable problem. I could never figure out how to get around that. And I actually didn't trade very much. I mean, I would trade, I would start for a few $1,000s and trade, and eventually just end up making one bad mistake and losing it, which is not hard to do if you're using fundamental analysis. But I never had much money at risk. But it never really clicked. And as you said, I had an analyst working for me who was Steve Kronowitz, who also became a very good friend and unfortunately, sadly, died this past year. And anyway, Steve, I noticed, was doing better. His calls were more likely to be right than wrong, and he was the only analyst I could say that for, myself included. And and so I sort of, sat down. We were friends even then. We worked in the same office and everything. And so we'd spent a lot of time talking about markets, and he explained to me the rationale of technical analysis, started showing me different things, and I started experimenting with it, and eventually got pretty comfortable with it. And for me, the decisive tipping point that switched me over was it was actually when I started using technical analysis routinely, but also married it with using protective stops. And I'm talking about chart analysis here, not computer trading at this time.
Right.
So and I still remember there was like a D-mark back. It tells you how far back this goes well before the Euros. We're talking D-mark days here. And the D-mark had come down a long way and had spent 6 months going sideways. And I said, oh, well, that looks like a bottom formation. So I thought, well, and I was never one to I never liked breakouts particularly, or waiting for breakouts, but so anyway, I said, well, I'm assuming this is a bottom. I went long, saw at the lower end of the range, and I put a stop in, not right below the range, but a bit of ways, So the market had to really penetrate it. And about a week or two later, I was wrong. The market penetrated the base, and it took out the stop. Now, the great thing about that trade is the market just kept going and going and going and going. And I was not losing any money. I just lost a little bit of money on the trade. And so that was a trade that sort of cemented in my mind the value of using a technical approach, because it allowed me to sort of marry risk management with the trading.
Got it. Yes.
Okay.
Jack, a related question that came from Twitter feed was, do you think a person is by nature either a trader or an investor, or can anybody play both the roles?
Well, I think probably some people are more attuned to both, to one or the other. But I think for a lot of people, both have, well, actually not for a lot of people, for myself, actually both have a role. So now investing could be, most of my money in recent years has been in real estate, so it hasn't had to do anything with trading, just simply because I couldn't figure out from an investment standpoint anything that I felt comfortable with. Because stocks are going up so much, and I wasn't comfortable with interest rates being so low, taking a bond risk. And real estate for me seemed like in certain markets, well, the markets I lived in, seemed to be a best value. But let's take it back to markets. I sporadically do take an investor role. That most of my activity in the markets is from a trading perspective. But sometimes I take an investing perspective, and it's a very, very different mindset. And I think it really can apply to really most people. So when you're just doing a trade, namely you think, oh, market X is going up or down, I'm going to take a position. I don't really know for sure, but I think there's a little bit of an edge if it goes one way or the other. You take your position, you know what your risk, you establish a risk, and that's your trade. Okay, fine. However, there are situations where that's not the right approach. Now, I'll use an actual example, probably the best example I can think of. Late 2008, when the world was crashing, I'd been around long enough. I thought, well, this looks like a classic, panic, and I had no idea how far it would go or when it would turn around. But my thought was, hey, okay, I'm not going to try to pick a bottom here or anything, but if I can find stuff that's been down, that A, has reason to have value over the long term, it's not like one company that can go out of business, and B, is down so much that I don't have to pick a bottom. If I just hold it long enough, it probably should be okay. Then that's a trade, and that's a trade I would do without any risk management. So, for example, back then, the trades I was doing were like buying ETFs in metals, ETFs in China, and often the leaps, the options, as opposed to the actual ETF, materials, basically ETFs in commodities and emerging markets, basically those two areas, because they were down like 75, 80%. And my simple assumption was, well, metals are always going to be used. We're not going back to the Stone Age. And secondly, emerging markets are having a rough period, but they'll come back sooner or later. And these markets have been down like 75, 80%. So I said, well, they might have been too high when they started, but at 75 to 80% down, if I just buy and hold, I'm prepared. I was prepared in that situation to just, if they went to zero. Well, metals are, metal companies as a group and an ETF are not going to zero. Emerging markets are just the whole emerging market or if it's India or China or even Russia, it's not going to is just not going to disappear. It's going to be worth something, right? So those were just the basic assumptions. That type of case, that's not a trade. I just said, wow. And I picked a spot maybe where he was like down to 20-year lows or whatever, and I just went long. And I had no stops. I had no plan to get out. I just put it on. And so that's an example of investment. It doesn't happen very often. And so for me, an investment is when something has come down so far. Well, I'll give you another example. I had a couple of years ago, I just went through a bunch of charts. I just looked at very long-term charts, 20-year stock charts, and of some major companies or whatever. And I just, in some cases, looked at it and said, oh, well, here's a good base. And if it gets down here, I'm willing to buy. So like IBM, I think it was like 200 or something. I think I put a buy-in. I think there was a base somewhere like 100, 110. I forget where. But it was like way down into a major support area. So I just put a buy-in. And like a year later, I got executed. It got triggered. And so,
right. It's almost like you, the latter example, it's like you use technical analysis for your fundamental call as well.
Well, yeah, you're right. Insofar, but basically you're right. So in those situations, I thought, fundamentally we're in a panic or it's overdone, way overdone. But I kind of define the overdone on very long-term charts. So even there's a chart analysis. The big difference is those type of trades, I have no stop. And if it goes to zero, it goes to zero. But those type of trades I won't do. Well, IBM, I guess an IBM could go to zero as possible. But I wouldn't do it on some, small stock that's, God knows what. But on a major, on an ETF or a very major company, I'm only doing it for a small amount of money of total wealth. I'm not risking a lot. I'm only risking a very small percentage per trade, per trade, rather speaking. So I'm prepared to not have any stops. But that is a very different psychology than trading. So I think one of the best pieces of advice I can give to people is decide whether something is an investment and a trade, and decide before you put on the trade.
Right.
So of course, people buy something and they'll buy something at 100, and they'll say I'm getting out if it goes to 95. Well, when it goes to 95, it becomes an investment. Oh well, I think I'm going to hold this. It's really worth more. So, but that's not an investment. An investment is something that you decide ahead of point. I'm willing to hold this forever.
But Jack, would you put you won't put stops, all right? But will you add on to your positions if they fall further? So you're not going to apply that if it was cheap at 100, it is going to be cheap at 50 psychology also.
Basically, those type of trades, what I do is I put in scale. The way I approach that type of trade, typically, the IBM was definitely just a one-shot trade, but the ETFs example I gave you in 2008, and we haven't had a major situation like that really since then. And well, I'm sure it'll happen again. But in a situation like that, what it is I put in scale down buy orders all the way down. So like the XME, I might be buying. I might have started. I forgot where I started buying. Maybe 17 down to 10 or whatever. But I would just scale in. So I decide ahead of time what the broad scale is, and I expect not to get the lowest orders because they're the really extreme. But the beauty of that is if you don't get executed on everything, you're basically never really behind much.
Jack, just one question there. So, because the readers are going to get a confusion because a good chunk of our listeners are fundamental investors. So when you started out, you were fundamental investors in commodities. Am I right?
Oh, that's no. That was still trading. That was still fundamentally based trading.
Sure.
That's different. So that's in futures where there's where your margin like 5%. So
yeah.
So so it's a very large loss to let it go. You can't just let it go to zero.
Right.
So that's always going to be futures markets to me are always trading markets.
Sure.
Never investment.
So in your experience where you have interviewed and you have profiled many investors, or let me call many traders come investors, have you had the luck of finding somebody who basically approached the markets from the fundamental aspect with risk management on stops and prices, etc.?
Well, yeah, there are people. Yeah,
and I'm saying stocks, not futures. So because I know future is too leveraged, so you have to have some kind of risk management in terms of prices. But who is exclusively dealing in cash market and not in leverage markets?
You're talking about in equities.
Yeah, in equities. Yes.
Well, not. I mean, I can think. Not people who use risk management. Basically, no. Because I think of people who do that. Like a Joel Greenblatt, who's a classic value investor.
Yeah.
Or somebody like Martin Taylor, who I interviewed in Hedge Fund Market Wizards. Those are people that they're buying value and they're willing to hold they're confident enough in their approach and diversified enough and allocate only, no more than a certain amount of risk to any position, that they're just willing to stay with the position. And they understand that there'll be periods where they'll take a drawdown because of that approach.
Sure.
But as long as they're comfortable with the fundamentals, they're not going to have a stop. In fact, just quite the opposite. I'll take Martin Taylor as an example.
Yeah.
When I interviewed him, he was, and for your listeners to give them context, Martin Taylor is sort of the best emerging market manager I ever that I was able to uncover. Although by the time I interviewed him, he was investing not only in emerging markets but also developed country markets. In any case, his funds had grown. He was managing about $7 billion with a B dollars when I interviewed him. And when I interviewed him, interestingly enough, he had just put out a letter to his investors saying he was going to close his funds. He had to give them a 1-year notice. And the interesting thing is he was doing this even though he wasn't too far. He may have been like 10% off. Well, he had put out the letter when he was actually not that far off his all-time highs. So he was doing it because he didn't want to be pressured by investors to avoid drawdowns, because if he felt the position was worthwhile, he didn't want to be pressured to get out of it. And so when I interviewed him, his biggest trade that he had on was Apple. It was his biggest loss at the time. He had like a 15% drawdown, which was almost all due to Apple. And this was back when Apple was 350 or so, before it split.
Which year was this?
This was in 2011, I believe.
Okay.
But in any case, he gave me the fundamental reasons why the analysts were wrong, and he was absolutely convinced that Apple was going much higher. About 6 months later, Apple had already doubled in price. But he's kind of sort of classic, a classic example. Greenblatt would be no different. He would basically, as long as the holdings met his criteria, he would stay with it. These guys would not use stops. So most pure fundamentalists, or I can't think of any fundamentalist that I interviewed that used a stop loss approach.
Sure.
It's like I say, it fights the methodology. They have to depend on being right significantly more than wrong, and on not having too much on any single position. In Taylor's case, his argument was, well, it's 350. There's like 250 in a bank. The stock is worth much more than it's trading at. He was just prepared to hold it, no matter what.
But you can do that only if you are in equity markets. You can't do that in futures and.
Yeah, absolutely. And yeah. I said, I would never consider futures investing. Futures in my mind are always a trading
instrument, right?
Always. Yeah. I would never. Yeah, I would think it would be very, very dangerous to ever treat futures as an investment.
Sure.
Right. Jack, I have a question around drawdowns and Sharpe ratios. At one end, we have people like Ed Thorp who say that if you don't want drawdowns, don't trade at all. And then on the other extreme, we have stars like Ed Thorp doing statistical arbitrage and who never had a negative quarter in his 20 years. Now, with such contrasting styles and variants, how do you measure success? Now, there cannot be a single benchmark or a yardstick, can there?
No, I guess not really. I mean, there are some yardsticks that are better than others. So in other words, in my own mind, something like a gain to pain ratio, which we can talk about more if you want, is a much better measure than a Sharpe ratio, or the Sortino is better than the Sharpe. But so there are better and worse measures. But you're quite right. Different people have kind of totally different approaches. Now, if you could do what Thorp does, or did, I should say, if you could do what Thorp did, then that's the best approach. I mean, Thorp literally turned the markets into a money machine. But he is the one in a billion individual. Jim Simmons in Renaissance was another one like that. So there are a few people like that come along, and they tend to be quants and figure out how the market is predictably, with a high probability, mispriced, exploit that inefficiency. Now, Thorp, and that type of thing doesn't last forever. Thorp, to do this, had to keep on reinventing himself. So he may have started out with warrants and options, having worked out the equivalent of the Black-Scholes model many years before it was actually published as a paper.
Right.
But that when pricing when he was no longer the only person in the world who knew how to price options, he switched on to he went on to convertible arbitrage. He was the first person to come up with convertible arbitrage, the first person to probably really successfully employ statistical arbitrage, and he took that one methodology. He took through various iterations as the rest of the world caught up. He figured out improvements that kept him ahead. So that's a rare individual. Now, if you can do that, and that approach resulted in a track record of 19 years with only 3 months of losses, all 3 of those months being losses of less than 1%. But that is the exception. Almost everybody can't do that. So if you have a more normal approach, you're going to have drawdowns, and that's just the thing. Then is to just be able to manage the risk so you stay in the game.
Right. In fact, I was reading his book, and I was amazed to see one of the strategies that he mentioned back then in 1960s was exactly what Mark Minervi's was doing. So he called it Midas or something. Interesting. Jack, I have a related question. I know it will be a touch difficult for you to answer this, but if I had to put a gun on your head and ask you to name the best trader that you've ever interviewed, who would that be and why?
Well, it probably would be Thorp, just for sheer return to risk, and I, by my very nature, believe that return risk is the only true measure. I mean, you can't look at return alone. Now, there are people who, in terms of return, sort of made many multiples of what Thorp did. But to me, to be able to do that in a smooth ride is actually the most impressive thing. So Thorp may have been averaging like 19% a year, and I guess somebody like Marcus in his heyday was probably doing hundreds of % a year. But still, that was or Sakota. When he had the markets, when he was early in the game of trend following, and he was one of the few people who were doing it correctly, may have had like huge, gargantuan returns. But that methodology, of course, like many others, the things don't let Marcus change. You can't. Any approach that works that well will go away, or certainly lose much of its efficacy. So there are people who certainly have had periods where they made more spectacular returns, but for on a return to risk basis, I don't think anybody that I've ever met could match Thorp.
Right. The gain-loss ratio that Jack talked about is profound. He's spot on. He says, don't judge things on just returns, but the amount of risk that you're taking for that.
Absolutely.
Sure.
And let me just add one point here, just to make, if anybody doubts that, I'll give you a very, very simple example. If you want to double your returns, I can tell you how to do that. Just double every position you take. You'll double your returns. You'll also double your losses. So by just that simple example, obviously return alone can't be a proper metric, because if it was, then everybody could become twice as good a trader by doubling their size.
Right. Got that. Now, Jack, I keep receiving messages from young people who are leaving their jobs to do trading and investing full time. Now, I think it happens all the time in any bull market. I wanted to know, what advice would you like to give them, considering that it is almost a loser's game, where winner takes all, and for every one success there are like 1,000 bankruptcies. But on the other end of the same coin, Jack, counter argument is that there were people in your book who failed spectacularly but came back from the ashes, so to speak. I mean, Marcus, the chapter 1, for example. So
right.
It is like catch-22 situation, isn't it? Do you trust your instinct or not?
Yeah, it's tough. I mean, look, you're right. Among the people I interviewed, not only Marcus, but he's probably one of the best examples because he did it multiple times. But lots of these people did flame out before they became successful. That's probably more more common to have met with early failure than to be immediately successful by far. So that part is true. It is also true that trying to earn a living as a trader is actually very, very difficult thing to do. And I think most people can do it. Even if you can trade profitably, trading profitably for a living is a whole different story. Because if you have to depend on paying your mortgage on how you do in the market, that puts a whole other line of pressure on it. So I think people shouldn't even try to trade for a living unless all the following conditions are met. One, they're quite confident that they have an edge, and they understand what the edge is, and they've proven it decisively to themselves. Two, they've saved up enough money so they can live for a couple of years and know they can go back and get a job if need be. And so if the trading didn't work out, they'd be okay. So I think those are two conditions that you need to have in place to even consider it. And understand that once you go to trading for a living, it puts enormous more emotional pressure on, and you have to be cognizant of that possibility. So it's not for most people. It's very difficult to do. And if you don't have enough savings, then it's almost impossible to do, because then your emotions will drive your trading. And if your emotions drive your trading, then you can't be successful.
Right. This is profound, Jack. Very, very important advice for the young. The couple of things that you mentioned, spot on. So, Jack, I wanted to pick your brains on pattern recognition ability of our mind. I happen to have a discretionary trading setup, and I've never back tested it. This very peculiar strategy where I catch the reversals. And to be honest, I'm actually very good at it. What I wanted to know was that, do you think that such a non-mechanical, discretionary approach has some merit? Or do you think it is all luck and the roll of dice has been nice to me?
No, I think, of course, it can always be luck. I mean, that's always a possibility. But no, I think that that is actually a viable approach. In fact, it's what I myself do. I mean, I basically look at charts and come to an opinion sometimes that I feel that something's going up or down for whatever reasons. I wouldn't bet a ton of money on my being right or wrong, but what I do is I always limit the risk on any outright trade, so I know ahead of time what I'm risking. And if I'm wrong, I'm wrong. So, but I kind of use a similar approach. In other words, it is totally discretionary off of charts. And so, yeah, I believe that is certainly a feasible, if you marry it with the big proviso is, yes, if you marry it with risk management. So that if you're wrong, you limit your loss. I think it's totally viable. And in this age of computers becoming more and more powerful, for most, to use a quant approach is probably for most people more difficult, perhaps, because you're competing against some really, really powerful quant teams and computer power and the ability to do enormous amounts of research on a quantitative basis. So very, very difficult for an individual to compete with that. But what individuals are very, very good at is seeing patterns. And they can be better at that than computers. In fact, even something like use an example of finding novas, supernovas, or things like that where they weren't before. Maybe not something that's because they might show up in a star chart where if there are thousands of stars, and then one shows up which wasn't there. You and I, some people who have the talent, are better than computers at picking that out. Or so for planets, maybe it's a better example. For being able to see a motion where some object moved, or maybe an asteroid or a comet, something that's moved relative to fixed positions. So the human eye can be much better than computer almost at picking some of those things out. And some people have that talent. So I think charts are in a way like that. Certainly you can't just look at a classic pattern and have that be the edge. You have to sort of combine. There has to be a lot of experience involved. And and the patterns probably are somewhat nuanced. It's not just one thing. It's certain patterns in the context of other things and so forth. And maybe it's a hint also of how a market behaves and whatever. But yes, I think humans could have an edge discretionarily finding patterns which are not easily put into a program because the patterns are, on something, for one, they may not be exactly defined because it's based on a lot of experience and an intuitive feel. And a lot of traders couldn't even define exactly what it is.
Right.
So that's one problem. Secondly, there's so many combinations of things that you can't test everything. If you did, you'd be worried about hindsight fitting. So I think, yes, I think it's certainly a viable approach.
Right, Jack. Thanks for that. Jack, I was going through one of your interviews, and by your own admission, you said while you were profitable overall as a trader, you would not consider yourself as an exceptional trader. Now, Jack, if after examining the best in business from so up close and personal, if you could not clone them, then who can? My question is, a great trader is born, or can the skills be cultivated?
Well, I think great traders are born. Great traders are born, and sort of decent traders or traders who can be net profitable maybe can be made. So I ran until about 10 years ago when I had my bad ankle, but even now I do long distance walking. But I ran for a good part, most of my life, actually from a teenager on.
Okay.
And I was devoted to it. And I would do it even when I was busy, and I would do long runs on the weekends. But no matter how devoted and committed I was to it, I never had the physical ability or the body shape to be, forget about competitive. I mean, nowhere within earshot of being competitive at any level. I just wasn't good in that sense. I could be, I could run 10, 15 miles at an 8-minute pace, but that's about it, And no matter how hard I trained, I probably could never have done better than about 7 minutes, So I would not have the physical capability to do it. Now, I could be more devoted than anybody else. I still couldn't do it. And so I could interview more traders good traders than anybody else, and maybe have a lot of knowledge. It doesn't mean that I have the natural intuitive skill to be a good trader myself. The only reason I don't lose money on balance is because I know so much. I mean, I don't think I'm a good trader. I just know enough, so I could be net profitable. But I just don't have the innate skill of the people I interviewed. And there's no reason I should. I mean, I interviewed these people. I am not these people. So I hopefully did a good job communicating what they did and the knowledge they conveyed. And I certainly picked up a lot of the knowledge they conveyed myself. And that's why, on balance, I'm profitable. But I certainly don't consider myself a good trader.
Got it, Jack. You sure did. You sure did justice to that. You literally brought them to life.
Sure. Jack, I have a question on your fund seeder platform. So the whole idea is that you want to connect some phenomenal traders with the people who want to provide them the capital to go ahead with. First of all, is it across the globe, or is it only restricted to US?
Absolutely across the globe. In fact, that's our whole concept from the very beginning was a global meeting place where we could find traders wherever they were. In fact, we have people signed up from over 100 countries.
Sure.
So we could find traders wherever they were, whether it was developed countries, emerging countries, not even emerging, anywhere. Could be people who were quants or discretionary traders or traded any instruments. We were just looking. We were sure that with all the millions or tens of millions of people trading, that there were a lot of people who had skill and had no chance of ever being discovered because they didn't have the right pedigree, they weren't in the right country, they didn't know the right people. So we wanted to create a sort of a neutral base where anybody could be judged based on the numbers and anybody could link their account to our site, and the numbers, because their numbers would be coming from the broker, the numbers would be verified, and we could also discover people who had trading talent that otherwise nobody would ever know of.
But will there be a discretionary element of judging the risk measurement of the execution, or are you going to rely on mathematical outputs? I mean, I'm pretty sure for hundreds of traders you can't have a discretionary way of judging risk. But return is pretty simple. But how are you going to make sure that you're getting the risk measures right?
Okay, well, basically we've got a lot of analytics on the site which the traders themselves can see and use and whatever,
sure,
and graphics and so forth. So we have all those graphics and analytics to look at what the trader has done, and so that's very helpful. But the initial search is purely quantitative. That's just to get a group of traders that we consider. Now, once we've defined that group, then we would drill down and begin with speaking to the traders and getting a better feel of what they're doing and so forth.
Sure.
But the first cut of who we look to speak to would be purely quantitative, and that's fairly simple. So just because somebody has done well, even return risk-wise, is obviously and certainly no guarantee they'll continue to do well, and it may not be a reliable indicator. However, what you can say, there's certainly no reason to expect people who haven't done well to start doing well. So it makes sense to start your search with people who have done well, and then try to go from that group to a subgroup who have done well, who you think have a reasonable chance of continuing to do well, and you can also then, when you combine them into a fund of a group of traders, you can then also use correlation analysis to get a diversified group, which basically improves your investment relative to any individual trader.
Sure. So in that case, so Jack, do you see a huge amount of strategy difference between various geographies? If that is the case, what I want to also take away from this answer is that all the knowledge which people like you have made sure that it's available to the world in form of books, is it really transferable? I understand it from the psychological perspective, but I'm saying from strategies perspective, is it as transferable and as valid for an Indian trader as it is for a US trader?
Well, since I have not traded Indian markets, I can't answer the second part of that question.
Yeah. Any emerging market you can pick. I mean, it's not specifically to India.
But there is universality of markets, and I think a lot of the basic things do transfer from one market to the other. Certainly, risk management, things of that nature, which are absolutely critical. Sorry, what was the first part?
When you get all these traders from 100 countries around, do you see a strategy difference?
The differences, So I can't. So basically, Fundseeders is two companies. It's Fundseeder Technologies, which is the site fundseeder.com.
Yeah,
and that's where we built out the analytics and graphics and the ability of people to link their accounts and so forth. We've also created indexes based on traders that are signed up. We've also got a leaderboard. So there's a lot of stuff on there. But building out those analytics and designing those analytics and really getting a critical mass of traders signed up, that's where our focus has been. Now we also have the one that is a precursor to Fundseeder Investments, which will then use the data of Fundseeder Technologies to find traders, which it can and has introduced to investors, and will use to introduce to other investors and to form fund products and also plan a multi-manager product. So that is more like stage two. And so we've been focused on really getting the investor side and the analytics working properly and expanded. And we've only just begun, as of the end of last year. I think Fundseeder Investments made its first allocation. And 2017 will really be the first year where all goes according to plan, and we will start making having introductions of consequence from the traders we find on fundseeder.com. So that I've deferred the serious searching of the database and analytics until we really were ready on the investor side.
Sure.
And that was stage 2. So now we're at the brink of that. And so in coming months, I will start really for the first time looking more detailed at the traders on the site and so forth.
Right.
But I haven't done that analysis yet, so I can't answer your question.
Sure.
Right.
Maybe next year.
Right, Jack. I noticed that you have developed 3 indicators for trade shock. I asked the same question to Ralph Wentz, who has developed some robust indicators. I just wanted to know first, where do you start to look for inefficiency while developing an indicator? And secondly, perhaps more importantly, how do you figure out that this indicator can have some edge in real markets? And how long will the edge last? Like, for example, Van Thorp assigns this SRN number to his trading system based on its internals. How do you do it?
Okay, so first of all, I got to tell you that I'm not an indicator person, okay? And I don't use indicators myself for trading.
Okay.
And when TradeShark approached me to do this, I said, I told him that. But then I thought about it, I said, however, I have developed systems, and there was a time where I was working for brokerage firms as research director. One of the things I did was design technical systems, and basically I stopped kind of doing that after 20 plus years or whatever. I had a partnership in the CTA at the same time. But in any case, what I thought was, okay, that's a great test. I said, I could take these systems, really groups of systems, and I haven't looked at them for 20 years. I have a partner I work with on all this stuff, a fellow by the name of Louis Lukac, who was also my partner when we had a CTA, and basically he does all the programming. So what the proposal that we do was just to run the systems that we had developed 20 years ago, and to see and to wait. The weightings come by really, let's say if there's 10 systems as an example, if all 10 are like one weight, that'd be 100. And if 5 and 5 is 0, that type of thing. But that's how we would get an indicator out of it. So we developed. So the beauty of that was it had been defined 20 years before, hadn't used it in the interim, and sort of my attitude was, okay, let's run this, and if it does okay, then that's valid. So we did it, and I compared it to CTAs and everything else, and basically it did better. So it was better than professional CTAs, and of course net profitable for that period of time. I think when we tested it, it was about like 18 out of 20 years profitable, and the statistics were reasonably okay. So I said, okay, so it seemed valid. That basically that's what it was. We did no optimization. In fact, the indicators were designed so they were not optimized. We did allow traders. I built the indicators so traders could define their own thresholds. So the indicators could be customized. So so there were like 3 indicators, about 10 ways of using them. They outlined different ways people could use them. So all I knew was that I had developed them a long time ago, tested them over sight unseen without optimization over an interim 20 years. It seemed to continue to work. Of course, there were a couple of losing years. There were years where it didn't work. But again, nothing works all the time. But on balance, most people would have been a lot better off using those than doing something else. So I felt it had validity, and those were the indicators. But what it didn't have, was the splash of picking a bottom, picking a top. These very nice trades that you see in advertisements. It didn't do that because it was designed to work over the long run. It wasn't designed to look great, over the past 2 years because it's hindsight fitted. Sure. And so by its very nature, that's the case. So anybody, using indicators would have to be, you'd go through drawdowns and like any other approach. And that's inherent in the approach. On balance, it was still working, even when like better. Even when trend following systems were doing poorly, it maybe didn't do great and may have had a losing year, but it still was doing better on balance. So that's what. So the basis of the indicators, there were trend and counter trend. It's a combination of trend and counter trend systems that were developed a long time ago, and then were just updated. Not updated. They were just tested to bring them up to the present time, and then those were the indicators, and that's what I provided. So, but I think most of the indicators, I think the audience of Trade Shark, I think that audience really is looking for like very short-term type of stuff. They get in today, get out tomorrow, that type of thing. And these indicators are certainly not that. So it's been disappointing on the sales side, but I'm a lousy marketer. I don't develop things to be from a market standpoint.
Sure. So, Jack, related question on that. How do you know that an indicator or the trading system that you've developed has stopped working? Is there a pain threshold that decides that?
No, there's no easy. That's how do you know any system has stopped working? It's very, very difficult. Right. I drew comfort from the fact that, like I say, it was tested over a 20-year. It was close to 20 years. Maybe it was. I'm trying to think. Maybe it was 15 years. But 15 or 20 years. It was a long period of time. So it was tested over a long period of time, and that doesn't guarantee it'll continue to work in the future. You're quite right. It could stop working in the future, and even in the past, there were a couple of years where it didn't do well. So there certainly are no guarantees. To me, it's just a matter of percentages, and anything that does better than the benchmarks is okay.
Right, I got that, Jack. What I'm saying is that not just these indicators, any trading.
I don't think it's very, very difficult. Very difficult to know when something stops working. And a lot of times it can fool you because things go through drawdowns. It looks like it's not working, and then it starts working again. So that is really. And I'll tell you, I've ultimately gone to pure discretionary after having tried systematic because I felt I had more control with discretionary. And you see, with the discretionary approach, if I start losing money, I start trading less. I cut my positions. I get out. So I may stop trading altogether. Right. With a system, you don't have that luxury because once you do that, you really break the system. So for me, it's a little more difficult. But there is no easy answer to that question. How do you know when it stops working? It's very, very tough.
Yeah, because for example, if I'm correct, Ed Secuta made majority of his money in the 70s and the 80s commodity markets, right? But if he sticks to the same system now, I'm not too sure.
I agree. And I'm sure Ed would probably agree as well.
Right. Jack, nobody in India has so far done what you have achieved of unearthing the superstars of trading and investing world. So if somebody wants to clone you and replicate your work in India, what advice would you give him about preparation and search? I mean, please give away your trade secrets, and pass the baton. Of course, if you're not interested in doing it yourself here in India yourself.
No, I'm not. So I'll feel free to share. I'll give my trade secrets are really writing secrets. They're not trading secrets. When it comes to the books, I mean, the books are more about writing. The books are purely about trading, of course, but the books are successful. Of course, they're successful to the extent that of the people who are in it. But I could have had the same people as books would not necessarily have been successful if it was written poorly. So the element that I can share is on the writing side, and the product of something like the Market Wizard books, all of them. It's not produced the way most people think it is. So I think most people. I'm sure the vast majority of people think, well, you go in, you interview the trade, you turn on the tape recorder, and you take the transcripts and you type them up. That is not what happens. And if that's what I did, my books would be a cure for insomnia. So you typically you can have hundreds of pages, of transcripts for any interview, and unless you've done this, people don't necessarily know this or are aware of this, but we speak very differently than we write. And I'm talking about educated people who express themselves well will still do so very, very differently verbally than they will in writing. And verbally, we don't finish sentences. We go off on tangents. We have tremendous run-on sentences. We mix ideas. We loop back into the same subjects. If you transcribe it, it is really a mess. And so, I'm a mess when I see my own words transcribed, and so is if you try to read it, and so are traders for the most part that I interviewed. So just trying to take raw transcripts and making that the text would be a horrible book. So what I'm trying to do is do two things at the same time. On the one hand, I'm trying, well, maybe more than two, but I'm trying to, first of all, be as true as I can to what the traders are saying in essence, not necessarily word for word, because that will come out sometimes being quite a mess, but as close to word as I can, where I can get away with it, where the trader has been, said things in a way that can be transcribed clearly. But bottom line, the idea is to be as true to the trader as you can. That's number one. Number two, you want to express the ideas in a way that reads well. Okay? So those two things don't necessarily go naturally together. So the transcript you have has ideas and some sections, some sentences, and some phrases that can work verbatim, but a lot of stuff that doesn't. And a lot of stuff is, the same idea may be in 8 different places and stuff like that. And the order of the conversation may not flow very well. But if you take 200 pages of transcripts and shuffle the order and clean up the language and combine similar sections, and do it in a way where it's still what the trader basically was saying, but you've cleaned it up tremendously and shortened it tremendously, you then have a final product that reads well, and the trader thinks that's exactly what he said, which is fine. In fact, I let the traders see what I have, and so we don't remember our conversations exactly, whatever. And so if you give back something that sounds like what they were saying or intended to say, that's going to seem just fine. So that's what I'm trying to do. And of course, a lot of it is actually verbatim, but they're phrases and some sentences, but the conversation as a whole is not the conversation as it occurred. Because the conversation as it occurred would not be easy, is convoluted, doesn't convey the ideas cleanly, and doesn't read well. So the idea is to capture all the important ideas, capture all the good stories, and put it together in a way that reads smoothly.
Sure.
Similar,
Sure. So one thing which if I have, and let me again reiterate that I am an investor and I've been trained as an investor, specifically value investing in equities. And even to a person like me, your books were just marvelous read. And even though I have very little interest in technicals per se, I think one of the big reasons is that you don't stop at a level. After that, you will keep on inquiring till the point it is absolutely clear for the reader what exactly the person is trying to say.
To me, an interview has to have two things to be utilizable. It has to have value of saying, there has to be stuff in there that has value in terms of advice to traders or insights for traders or investors. That's number one.
Yeah.
And it have to be able to make it read well. And if I can't turn it into something that reads well, then I just can't use it.
Sure. I understand.
Well, Jack, that is it from my side. I don't have any more questions. I just wanted to know, can you please recommend some names that you think we should profile in our podcast?
Some names, meaning what names? You mean of traders?
Yeah, people that you think.
Yeah, well, I'll tell you one a good friend who's been a good trader. He's been a successful trader for 40 plus years. Is Peter Brandt. You can find him from. He has a site called The Factor.
Yes. I know Peter Brand.
Okay, so he's one I'd recommend.
Okay.
I think he has a lot of valuable stuff to say about trading.
Right.
Peter and I think a lot the same too, so maybe that's why I like him. But
Right.
when I listen to his answers, when he gets asked a question and he answers it, he almost answers it the way I would. So it's and vice versa. So
Sure.
but he has a lot of good things to say, and he's been around for a long time. He's a true veteran and a nice guy. So yeah, I'd recommend Peter.
Oh, okay.
Oh, and I'd mention one other thing because you may not be aware of it. Everybody knows the Market Wizard books, but I just recently redid what was actually my first book, which was an analytical book. Except this time around, it's probably more emphasis on technical than fundamental, and it's called A Complete Guide to the Futures Markets.
Yes, Jack, I'm aware of that.
Yeah.
A very.
I just want to, but I wanted to say on that, the publisher initially put it out, in a tissue thin paper because it was such a thick book. Well, it would have been a thick book. Now it is a thick book. It is a thick book again, but they tried to make it the same thickness as their other books. So because there were over 700 pages, they dealt with it by making the pages thinner, and so there was horrible quality paper. So I got them to change it, and so there's a reprint now. Amazon is, I think, in sort of an interim stage. They were supposed to be pulling the copies off of Amazon. There were only a couple hundred left, I think.
Okay.
And then putting out the new. But when the new copies are available, when the good quality copies are available, it will say so.
Okay.
So I just want to make sure that people don't get particularly from third-party vendors, because Amazon will take it off, and then it'll be available from third-party vendors who will still be selling the first printing, which was on this poor quality paper.
Got
And
it.
the publishers already reprinted. They've already reprinted it on good quality paper. I have a copy of it. And once Amazon has cleaned their inventory and gets the new books, that's what's going to be on there. But it will say that. So I just want to make sure that people are aware and make sure that they get the new version of the book.
Got it, Jack. And thanks for clarifying that. It's important. Yes. Right, Jack. That's it from my side. It was a pleasure hosting you. So much learning. Really appreciate your time.
I appreciate it. You asked some very good questions, and it was fun doing. Thank you.
Right, Jack. Thanks. Take care.